Stop scrolling for a moment. What I'm about to explain might sound uncomfortable, but history says you should listen carefully. The last time markets felt this confident, something broke. Not slowly, not politely. It collapsed. In 2000, people believed the internet had rewritten the laws of economics. In 2008, people believed housing prices could never fall nationwide. And today, millions of investors believe one thing with absolute certainty: artificial intelligence stocks cannot fail. Nvidia, Palantir, AI is the future. AI is unstoppable. AI is guaranteed growth. But markets are most dangerous when everyone agrees, because when doubt disappears, risk doesn't disappear, it hides. And that is why this video matters. Because after almost 2 years of silence, the man who predicted the 2008 financial crisis, Michael Burry, has quietly returned and placed a massive bet against AI stocks. No interviews, no explanations. Just one move revealed through an SEC filing. Nearly $1 billion betting that something is wrong beneath the surface. This video is not about hating AI. It is about understanding risk, market psychology, and why extreme confidence is often the final warning sign before reality hits. To understand what's happening today, we need to understand a pattern that repeats again and again in financial history. Every major crash looks different on the surface, but underneath, the structure is almost identical. First, a powerful story appears. Then, rapid growth follows. Early investors make money. Media attention increases. Skeptics are proven wrong. Confidence grows. Valuations rise faster than fundamentals. Finally, certainty takes over. People stop asking what could go wrong. That is the most dangerous phase. Because crashes don't happen when fear is high. They happen when fear is gone. In the late 1990s, the story was the internet. It was real. It changed the world. But investors believed profits didn't matter anymore. In the mid-2000s, the story was housing. People needed homes, so prices could never fall. Lending standards collapsed quietly. Leverage increased silently. When the system broke, it shocked everyone, except a few who were watching the structure instead of the headlines. Michael Burry was one of them. Michael Burry is not famous because he got lucky once. He shorted the dot-com bubble. He warned about the housing market years before the collapse. He made over $700 million during the 2008 crisis by betting against mortgage securities when almost everyone else believed the system was safe. He was mocked. He was early. He nearly lost everything before being proven right. That detail matters because it tells us something important. Being right too early feels the same as being wrong. After deleting his Twitter account in 2023, Burry went silent. No warnings, no commentary. And then suddenly, one SEC 13F filing revealed something unusual. His fund had taken large options positions against Nvidia and Palantir. Headlines focused on the number, $1 billion. But let's slow down and understand what this actually means. This is not a traditional short position. This is an options trade. The actual cash invested is much smaller, but the risk is total. If these stocks do not fall within a specific time window, the entire position can expire worthless. This is not a hedge. This is not diversification. This is a high-conviction bet. And people like Burry only take bets like this when they see a structural imbalance. So what imbalance could exist in companies as powerful as Nvidia and Palantir? To answer that, we need to understand how modern bubbles form. They do not look foolish. They look smart. They are built on real innovation, real products, and real demand. The danger begins when expectations grow faster than reality. One of the first warning signs is something rarely explained clearly: circular growth. In today's AI ecosystem, money often moves in a loop. Nvidia invests in OpenAI. OpenAI signs massive cloud contracts with companies like Microsoft and Oracle. Oracle and Microsoft then spend billions buying Nvidia GPUs. On paper, this looks like explosive growth. Revenues increase, valuations rise, headlines celebrate unstoppable demand. But pause and ask a simple question. Where does the loop end? Who is the final customer creating independent demand outside this ecosystem? When money circulates inside a closed loop, growth can look strong even when it is fragile. This is exactly how the dot-com bubble inflated. Companies invested in each other, bought from each other, and justified valuations using each other's growth. The internet didn't disappear in 2000, but investors who bought at peak optimism suffered massive losses. This does not mean Nvidia or Palantir are fake companies. Nvidia builds world-class chips. Palantir has real customers and long-term government contracts. The issue is not existence. The issue is valuation. When markets price in perfect growth for years into the future, reality becomes the enemy. Stocks do not need bad news to fall. They only need news that is less good than expected. The second major warning sign is capital expenditure. Right now, companies like Amazon, Google, and Microsoft are collectively spending more than $320 billion per year building AI infrastructure, data centers, power grids, cooling systems, land, long-term contracts. This is not experimental spending. This is irreversible spending. Once this money is deployed, it cannot be easily undone. Historically, massive capex booms tend to appear late in market cycles, not early. In the early 2000s, telecom companies built enormous fiber optic networks, expecting explosive demand. The demand did arrive, but much slower than expected. Prices collapsed. Returns vanished. Investors faced a lost decade. Supporters of today's AI boom argue that this time is different. They cite efficiency gains, productivity growth, and economic theories like Jevons paradox, which suggests that increased efficiency can increase total demand. This argument may be partially true. AI will likely improve productivity across many sectors, but markets don't crash because growth stops. They crash because growth disappoints. When valuations assume perfection, even strong outcomes can lead to sharp declines. Another hidden risk is leverage. Margin debt in the stock market has crossed $1 trillion. This means investors are borrowing heavily to stay invested in rising stocks. Leverage feels harmless during bull markets. It magnifies gains and hides risk. But when prices fall, leverage accelerates losses. Margin calls force selling. Selling pushes prices lower. Lower prices trigger more margin calls. This feedback loop is how normal corrections turn into crashes. In 2008, leverage transformed a housing slowdown into a global financial crisis. Today, the system looks innovative instead of fragile, but the mechanics are the same. Another signal that deserves attention is cloud growth. Cloud infrastructure is the backbone of artificial intelligence. Every AI model depends on it. Recent data shows that cloud revenue growth at major providers has begun to slow compared to previous years. This does not mean AI demand is collapsing, but it does challenge the narrative of unlimited exponential growth. Some argue the slowdown is temporary, caused by delays between infrastructure build-out and actual usage. That may be true, but markets are priced on expectations, not explanations. When expectations are extreme, reality does not need to be bad to cause disappointment. It only needs to be less perfect. Now comes the most important question. What does this mean for ordinary investors? The biggest mistake would be blindly copying Michael Burry. He uses options. Timing matters. Even when he was right in 2008, he suffered enormous pressure before being proven correct. Markets can remain irrational longer than most people can remain solvent. Not every AI stock is guaranteed to crash. Nvidia's revenue growth is real. Palantir's contracts are real. This is not a call for panic. It is a call for awareness. History teaches us a difficult lesson. Revolutionary technologies do change the world. Electricity changed everything. The internet changed everything. Smartphones changed everything. But investors who bought at peak optimism often waited years, sometimes decades, for meaningful returns. The biggest losses occur when people confuse technological progress with guaranteed profits. Markets do not collapse when fear is everywhere. They collapse when confidence is absolute. And right now, confidence in AI is everywhere. That doesn't mean a crash is guaranteed tomorrow. It means risk is being underestimated today. This channel exists for moments like this. Not to predict exact dates, not to spread fear, but to sound the alarm when risk is ignored. If you want comfort, this is not the place. If you want clarity, logic, and awareness, this is Finance Alarm. Stay alert, because bubbles don't burst when everyone is scared. They burst when everyone feels safe.